Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. My name is Pushpendra Mehta, and my guests for today are Craig Jeffery, Managing Partner and Strategic Treasurer, and Paul Galloway, Senior Advisor at Strategic Treasurer. This week, we are focusing on 7 stories that cover 3 themes, namely payments, acquisitions, and global economy, currency reserves, and trade. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Our first story for today is about SWIFT announcing itself as a global hub for central bank digital currencies and tokenized assets. SWIFT has successfully shown that CBDCs and tokenized assets can move seamlessly on existing financial infrastructure. The findings from 2 separate experiments solve the significant challenge of interoperability in cross-border transactions by bridging between different DLT networks and existing payment systems, allowing digital currencies and assets to flow smoothly alongside and interact with their traditional counterparts. Craig, do you think the SWIFT findings from the CBDC and tokenized asset experiments is a major milestone toward enabling their smooth integration into the international financial ecosystem?
SWIFT is a network, and where's the value of a network? It's how broad is it, what you can do on the network. And so this certainly increases that activity. When we think about currencies, how well accepted are they? Is there a ubiquity among that it can be accepted in different places and traded freely? The more that's open, the less friction there is. And so this accomplishes, or it points to being able to accomplish both of those. So whether it's central bank digital currency or, as we refer to regular currencies as fiat currency, it addresses both of those. And I think that bodes well for the digital currencies as well as SWIFT's relevance, continued relevance in the space. So it solves some of those issues, and they're leveraging their trusted place. So it's probably too early to say definitively, but I'm liking what I'm hearing here for the strategic reasons I mentioned.
Paul, what are your thoughts?
Yeah, I would tend to agree with what Craig said. Let's face it, it takes a certain adoption rate before things become relevant out in the markets, especially on a global basis. And from Swiss perspective, I think this is definitely a positive step forward. And we keep seeing advances with tokenization, digital currency, blockchain, whether it's DeFi, CeFi, all these things that are still relatively new are becoming more and more relevant as we see adoption rates increase and organizations like SWIFT taking steps forward to make it more relevant.
Moving forward to the second story for today that pertains to small and medium enterprises in Europe and the interest in real-time payment solutions. More than 2/3 of European small and medium enterprises are planning to adopt real-time payment processing in the next 12 months, new research from Vodeno has revealed. Small and medium enterprises are foundational pillars of the European economy, representing 99% of all businesses in the region and accounting for more than half of Europe's GDP, according to research by Vodeno. Paul, if 68% of the European SMEs were to adopt real-time payment processing capabilities, do you think it will enhance their available cash flows? And do you also think the availability of real-time payments is likely to lessen legacy banks' position as the default payments provider for many SMEs?
I definitely think increased adoption rate for small to medium-sized businesses for real-time payments does make a difference. One, it makes a difference to a business like that. Oftentimes, turnover for your receivables, payables, from perspective of being a small business can be a challenge because you might not get the receivables as fast as some other organizations that are bigger can weather storms a little bit better than small businesses. So I think anytime you can make the pace of turnover quicker, it's going to be better for a business writ large. So I think the fact that you see, adoption rates or the intent of adoption rates to be at that kind of rate, I think that's very significant. There's a lot of small to medium-sized businesses out there, not only in Europe, but here in the U.S., we see a similar kind of footprint. A lot of developed countries have tons of small businesses that have impacts on local economies and the economies writ large. I see this as something very positive. I can see that with increased adoption rates as well, that we could see costs coming down at the same time, which has been kind of a barrier for some of the smaller businesses to adopt this particular bank-offered real-time payment solution.
Back to your question, Push, about what's going on here. We do quite a bit of research on payments as well, and this willingness to move, if their banks aren't keeping up with some of the newer payment formats, is certainly well stated across the board. Now, we've not seen percentages like this where 57% intend to switch payment providers in the upcoming year. We haven't even, it's not anywhere close to that, but our surveys cover small, medium commercial clients, large corporate clients in a more balanced level. So this is really targeting the smaller businesses. I think this is really an interesting trend and projection. So whether that will hold, whether it'll be over half that make the switch, or even if it's a quarter, I think it's indicative of the change that's occurring to move to faster, to move to more complete. Faster isn't the only reason for doing something, but it certainly is a reason. Nobody's going slower. So this is quite a wake-up call to the percentage of banks that aren't keeping up. Long ago, there was this whole disintermediation risk that fintechs would take away the businesses of banks. What it's really developed into has really been more of a partnership model and partnership approach. Now, what we're seeing here is there's a potential that there is some disintermediation at these levels. And so those banks that are playing a wait and see or catch up approach may be losing a significant portion of their smaller business clients, at least for the payment activity. When you lose that, can you get that back? Well, if you're a bank, it's easier to get it back, but it's still hard to get it back. So, a lot of the super regionals and global banks, the $1 trillion banks, are staying very much at the forefront. So I think this presents a risk to the more localized or regional banks that aren't keeping up. I think this is pretty interesting research, especially when you see these 4 countries that level plan to switch.
Very interesting. Let's move forward to the third story of the day, which is about HSBC considering selling its business in Canada worth as much as US $10 billion, according to Bloomberg News. HSBC is one of the biggest international banking brands in the country, and its Canadian unit has been the third largest contributor to its commercial banking profits globally. Craig, if I may direct this question to you first, were you surprised to hear that HSBC, once styled as the world's local bank, is considering selling out of Canada? And do you think this is a part of HSBC's broader retreat in North America as the bank shifts its focus to Asia because of its largest shareholder, China's Ping An Insurance Group, that is pushing for splitting HSBC's business into Western and Asian hubs?
I think the latter rather than the former. Was I surprised? Yes and no. Yes, because, Canada's a very strong Western market, very wealthy, good for banking. But no, because HSBC and a number of other banks are focusing on particular regions. So they're pulling back and pouring more of their capital into particular areas. They have to do that. That's what the HSBC is doing. And when I say they have to do that, everyone's focused on where are they going to get the growth and the most synergies in the coming years. And so that part's not a surprise. I really didn't expect it to come from Canada, but, as you think about, Canada and US, a retreat from that area, there's synergies in being in both, but it's also, these are huge geographies. US has a very large population, very wealthy. Canada is very wealthy. much smaller population, about 15%. So, I guess if I were to have thought about it more, it wouldn't have surprised me in either direction. We're going to continue to see this concentration, certainly over the next year, maybe beyond that as well.
And Paul, what are your thoughts about this?
Yeah, I think this is definitely an interesting development. Their presence in Canada is significant to their revenue. When I think about this from an M&A standpoint, I view this as a purely strategic play by HSBC. And so they're looking at this going, hey, we have an opportunity to take an asset that has a lot of value on the table today. We can take that capital and redeploy it into a strategic market that we feel is going to generate a better return for our shareholders. And I think that's where their head is. And I think that's where Craig was talking about synergies. And I think the synergies that they get by focusing in other markets will allow them to take, whatever it is that they're going to get out of this divestiture and redeploy it at a higher multiple. And again, I think it's really a strategic play for HSBC. Do I think there's an opportunity for a counterparty to acquire these assets? Yeah, I think there is. I think the presence, the footprint that HSBC built there, it's not going away. I think it would be a good opportunity for the right banking partner. Who that will be, I guess we're going to find out.
Our next story is about the World Trade Organization, or the WTO, anticipating a sharp slowdown in world trade growth in 2023 because of interest rate hikes imposed by central banks worldwide, shrinking energy supply, and soaring inflation. The WTO now estimates that global merchandise trade will grow by 1% in 2023 against its 3.4% forecast last spring. The move by OPEC Plus to slash oil production by 2 million barrels per day to shore up prices and the escalating Russia-Ukraine conflict may result in curtailed export of food, fertilizer, and fuel, thereby putting the already fragile global trade recovery at further risk. Paul, do you think the current global trading environment has heightened trade finance risks for corporate treasurers? And if so, what risks in trade finance should corporate treasurers be most concerned with?
Yeah, Push, I think there's definitely risks out there corporate treasurers need to be aware of and are most likely concerned about, given what the current environment is. I mean, the WTO's view is certainly, it's not good, right? 1% global trade. You think about what's going on in the markets out there. We're going to see credit continue to be pulled back. We're seeing stress on banks already. Credit Suisse is a great example of a bank that's getting some stress. Some of it is perhaps panic driven, but you're starting to see that I think balance sheets are going to become a lot more tight. I think access to credit and finance is going to be more difficult. You're going to see less counterparties willing to extend credit for trade finance. So I think it's just going to get more difficult. Do I think we'll grow out of it? I think over time we will, but 2023 is shaping up to be I think a pretty tough year. And if I was to advise treasurers today, I think what they need to do is they need to make sure that they have the right funding vehicles in place, the right partners in place, that they can get the credit when they need it. Yeah, it may come at a little additional cost, but getting that put in place today, I think will be real beneficial for trade finance platforms and for the treasurers that are managing the cash.
I think the WTO is also playing catch up to what's going on around the globe. The slowdowns there, was it 96% of economists believe there'll be a global recession next year, and some of the comments there are, what does an individual country do when they've let inflation get out of control? They're playing catch up, and so you see some dramatic movements, particularly in the U.S. doing that. I think there's some other comments that we saw in that article about some countries limiting exports of food, fertilizer, and fuel, and there's some criticism for that. And there's a human element to that. There's also a wartime footing element to that. I think that what Russia is doing is having an impact there. And so there's an awful lot of headwinds and not too much tailwinds to push things along. So somewhat depressing realities that we're seeing, just like we're seeing, fuel prices bounce back. The U.S., I think, has to stop pulling fuel. They're pulling about 800,000 to 1 million barrels a day out of the strategic reserve. Well, that has to stop. We're about at the end of their ability to do that without going further in the hole. And you see OPEC is dropping their production 2 million barrels a day. That's a 3 million barrel a day swing. And while the economy has cooled, decreasing the demand, we're heading into winter. And when you have an imbalance of supply and demand, and the demand is higher than the supply, that's going to push prices up and create some other carry-on effects.
You make a great point. And our fifth and sixth story revolves around something else which is of concern to U.S. multinationals, which is the rising value of the dollar and its effect on corporate earnings and global currency reserves. The meteoric ascent of the dollar is taking a bite out of corporate earnings, particularly for U.S. corporations doing business abroad. Corporate earnings are expected to be negatively impacted by a soaring dollar in the third quarter of 2022, which could reportedly pose yet another challenge for stocks in an already difficult year with declining markets. In addition, the dollar's rise to 2-decade highs against other reserve currencies such as the euro and yen have reduced the dollar value of these currencies' holdings. Global foreign currency reserves have reportedly fallen rapidly by approximately $1 trillion to $12 trillion this year, according to reports. Craig, if I may direct this question to you first, do you believe that the dollar will continue to trade higher against major currencies? And is there anything on the horizon that could break the dollar's climb?
Well, there's certainly things that could break the dollar's climb. I don't know how long this will play out, but certainly as a primary reserve currency, and in a time when the Fed continues to raise interest rates, there's going to be some continued pressure there. And then as we see weakness around the globe, more weakness perhaps than in the U.S., so let's say the UK, parts of Europe, that all points to an ongoing weakening of other currencies. I wouldn't necessarily say a strengthening of the dollar. I know it's the opposite side, but I think it's a different type position. To the extent that the economy slows down dramatically in the U.S., maybe if it slows down more so, that would create a shift. But currency valuations in the future and changes and shifts are not an area that we're really focused on. We tend to be focused on how do you handle that volatility, but we certainly see a lot of volatility going forward. It seems to be indicative of a strengthening dollar, weakening pound, weakening euro. But there's a lot more people who have comments on that. Your comments about the reduced earnings, our company is always short on pounds, long on dollars. And so, the weakening there is, for us, it tends to be a positive thing. But there's an awful lot of global companies where it's the other way and it's more costly to buy the products from the U.S. or services. So
I certainly don't have a crystal ball, but based on what I've been seeing from reports that have been coming out, I believe we have PPI coming out here soon, tomorrow maybe. I think we're going to see continued pressure on inflation until we can get our arms wrapped around inflation. I think the dollar's just going to continue to be strong. We probably got several more quarters before we see the dollar start to weaken. Sometime in 2023, maybe we'll see a turn, but until we can get inflation down, we're just going to continue to see that problem be exacerbated. And certainly the quarterly earnings coming up here, all the analysts out there are saying, hey, it's going to be really ugly. It's going to be bad. Fully agree with that. How bad? I don't know. I believe it's certainly going to be bad. It definitely has an impact on what's going on, from a global perspective. I think as we continue to work through this cycle, there's just going to be some additional pain that's going to be ahead of us, unfortunately, until we break that cycle.
The seventh story for today is about the US government tightening its export regulations, among them a prohibition on China using a specific type of semiconductor chip produced anywhere in the world with US machinery. These new restrictions on technology exports to China could undercut China's ability to develop semiconductors, supercomputers, surveillance systems, and advanced weapons. Do you think the US curbs on China's access to new chip technology will impede the development of the Chinese tech sector and also impact global supply chains and recovery of the world economy?
Well, I think the first part's definitely the case. I think it is intended and will impede China's tech sector growth. That's certainly the case. There's quite a bit going on there, and it's on a geopolitical scale. Concerns about where chips are being made. There's been a push in the U.S. to bring more onshore production of chips. With concerns about Taiwan and other places. So this is certainly an area of battle from a treasurer perspective. What does this look like? I don't think it necessarily impedes the overall economic growth of the world as much. This will, in the long term, bring about more development locations for chips and result in an increased supply, which will increase the demand. So short term, probably a little bit of a decline. Longer term, there's going to be some of the major economies are going to be producing chips more than being reliant in single areas or single industries.
And Paul, do you have a similar opinion, or do you differ?
Yeah, I do have a similar opinion. This is definitely targeted. It's intentional. I do think it is going to have an impact, already has on Chinese chip stocks. Do I think globally it's going to, change things from what we're seeing today in terms of profits and so forth? I think this is what Craig alluded to. We're seeing a shift in where chips are going to be manufactured. Given some of the stress and pains that we've seen recently in Taiwan, makes sense that this is a strategic move by the U.S. Are we going to see technology get lambasted by it? No, I think other things will impact what's going on with profits from a chip making standpoint or technology standpoint, especially when we think about the global economy, the war in Ukraine, other things that are creating pains and issues globally from an economic standpoint. So I think this being a factor, perhaps a factor in China, but globally, less of an impact than what we're going to see happen in China.
Finally, I would like to wrap up this conversation by seeking your opinion on your choice for the biggest or most important story of the past week and why. Craig.
There's one theme that one of the stories picked up. The theme is this: we're releasing currency reserves to protect and to prop up our currency. The article about global currency reserves decreasing, particularly countries selling off the US dollar. This is to prevent, the free fall. It's only a temporary measure to stave off a rapid decline, and only lasts for so long because you only have so much currency. We've seen the same type of behavior in the US, not on currency, but on energy prices, with the releasing of 180 million barrels of fuel out of the strategic reserves, meant to reduce some of the cost, not for war, not for major, cataclysmic events or storms or a shortness, but to do that, and largely, I think, in preparation for the midterms, to release that activity. Well, you only have so much to do, and once you finish that, you don't have any more, gunpowder left, and so you've eliminated your ability to do it. So I think you have to be very judicious when you release reserves of currencies, when you release reserves of fuel. And I think that's the theme that is most indicative of people trying to have a soft landing. And sometimes that creates a harder landing. And hopefully they're right. But I fear both of those are going to be a bit harder of a landing on currency and on fuel.
And Paul, what would your choice for the biggest or most important story of the past week be, and why?
One of the most impactful stories that has come recently is the war in Ukraine. What happened with the bridge from Crimea over to Russia and Russia's response in Ukraine. It's very troubling from a global perspective. My hope is that the escalation that we're seeing doesn't lead to worse things like tactical nuclear weapons and, the need for others globally to jump into this war that, that Russia has clearly started. I do have concerns about it. It's getting uglier. There's no doubt that there's going to be a significant impact in Europe with what's going on over there. I think there'll be potential there for some broader global impacts, especially if this continues to escalate the way it is.
Thank you, Craig and Paul, for your insightful analysis. We would also like to thank our CTM File audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.